With the festival season underway and the Festival of Lights just a few days away, we decided to bring you some great stock ideas that can light up your portfolio. Hello and welcome to our CNBC TV 18 Diwali special. I am Prashant Nair and with me is my colleague Surabhi Upadhyay. Hi Surabhi.
Hi Prashant. First of all, season's greetings to you, to all of our viewers who are joining in and are going to be with us for the next half hour to take a look at these stock ideas. Well, joining in are the experts with their top stock picks, and they are our very own Marketwallah'S, SP Tulsian of sptulsian.com, Prakash Diwan of prakashdiwan.in, and Deepan Mehta, member of the Bombay Stock Exchange as well as the National Stock Exchange. Gentlemen, welcome to the show. Season's greetings to you and thank you for being with us.
Thank you for having us.
Let's dive straight in without any preamble, without talking about macros or top-down, anything of that sort. I mean, this is the show where we will tell our viewers what can you buy in terms of stocks which will make you a lot of money over the next 1 year or so. Mr. Tulsian, let me start straight with you. Your first pick.
Prashant, let me first give the greetings, for the festive. Happy Diwali and prosperous New Year, and we wish that Samvat 2075 becomes quite profitable. To start with, I'll say that my first pick is Century Textile. It's a very interesting play. In fact, people sometimes get confused with the name as a textile stock. In fact, when the demerger is happening, which is underway, they call it as a cement stock. Paper division is contributing about 35 rupees to the EPS on an annualized basis, and then they have the real estate, which is already yielding some annuity income, and apart from that they have the net present value of double the value of the share, of the market cap. Now I'll quickly go through the cement demerger. 13.2 million is going to Ultratech, for which people sometimes get confused at what is the swap ratio, will Century Textile get extinguished and all those things. But if you are holding 8 shares, 1 share of Ultratech will be given, which effectively translates into 53% of the present value. And what Ultratech is giving apart from these 8 shares, they are assuming the debt of 3,000 crore plus the contingent liability of 730 crore. So what will make the Century Textile virtually debt-free, because the long-term debt is closer to about 3,300 to 3,500 crore. Of that, 3,000 crore will go to Ultratech on transfer of this. So cement division will go away, but even after transferring this 13.2 million, Century will be having the 1.2 million ton residual cement plant, which is not being transferred, maybe for pending clearances of the mining leases and all that, which can also fetch 750 crore. So you have knocked off the cement completely, because that was not doing well. That was not the, maybe because of the old plants and all sort of things. So company is becoming debt free, remaining with the textile, paper and real estate. Come on the real estate, about 6 lakh square feet has already been leased out in the area of Prabhadevi and Worli, which is a central Mumbai, on which company is yielding an annual annuity rent of about 150 crore. We all know that with the income, under the income from house property, you get 30% discount. So effective tax liability is about 20%. So you yield or you generate an EPS of closer to 13-14 rupees. I'm not considering the annual increment. And the assets are all owned by the company. Apart from that, they have a 50 lakh square feet area available for development in central Mumbai, again where the residential rates are prevailing in the rate of about maybe 60,000 rupees a square feet, which will eventually get developed over 5 years. I am not referring their land at Kalyan and Talegaon and all those things, but the net present value of this Worli land, which is pending for development, is estimated at 7,500 crore. Come quickly on the paper plant, 2,40,000 ton plant, of which 36,000 ton is tissue paper. That is generating an EBIT, I am referring EBIT, earning before interest and tax, of 500 crore. Because it's a virtually debt-free company, no interest, tax liability is effectively at present is about 10% because of MET. But even if you consider it at 20-22%, the paper plant can give them an EPS of closer to about 35-40 rupees. I'm just referring this on the residual business. Textile, take that as a neutral, no contribution to the bottom line. Eventually, you may see after this cement division demerger, you may see an eventual EPS of closer to about 50 rupees or maybe 40 to 42 rupees for FY19, 50 rupees for FY20. And the residual value of the shares will be less than 400 rupees. So you have a good value coming in. Pedigree is very good. You need 50 lakh square feet to develop about 5,000 crore, which can get generated by the company over next 4 or 5 years. So share, which is now ruling at about 820, we expect the share to move to a level of 1,025 in next 12 months, yielding a gain of about 25%.
Okay, so that is our first pick for the show. Century Textiles. Prakash, I want to move on to the stock that you're going to talk about, and I think you've gone with ABB, which is an interesting pick, considering that cyclicals are still pretty much out of favor. Not too many people are talking about them. So what is making you optimistic on this one?
No, absolutely, Surabhi. So festive greetings for all of you and to the viewers. And the reason why some of these stocks that have been out of favor, cap goods particularly, as you rightly said, is because we didn't see any traction in terms of the order booking and all. But this is one business that's firing on all cylinders. You have four verticals largely: the power grid business, the robotics and motion business, the industrial automation business, and the electrification products, where you have a lot of the charging infrastructure, which is likely to be a big trigger. What they've hit upon as the jackpot is that they have been evolving themselves to become a global factory for their parent business. And 9 of their product lines are now being serviced from India, which is remarkable. I mean, that's happened with Cummins, that's happened with FAG Bearings. A lot of these businesses have done this very successfully. So they're backwardly integrated across the value chain. I think ABB has some optionality or some triggers which are really promising. One is the railway business could grow very, very positively. Just right now, it's about 8-9%. It could change. They have something called ABB Ability, which is the industrial digitization which they are carrying out, which is a very quiet kind of a move. And look at the numbers. There's nothing to complain about. The valuation has always been slightly rich, but then that's the way an MNC stock gets valued. So I think you're just getting it at the right time. Hopefully for a year's time, 18 months period, you could probably get a very decent 1600 kind of a value on this stock, even if things remain the same.
Okay, so that is ABB coming from Prakash, and out of the 9 stocks, we get to the first consumption pick. Deepan?
Yeah, that's right. So my Diwali pick, and first of all, happy Diwali to you and the entire CNBC team and your viewers. My first Diwali pick is Thomas Cook. And it's a company which has been around for many, many years, decades in India. It's a fantastic brand. They have done many acquisitions in recent time, and it's been a while to integrate all those acquisitions, and now they're kind of in a steady state. At the same time, they face disruption in the form of online portals like Yatra and Make My Trip, but they've managed to take on that competition and create their own niche within the financial services space and the travel industry. So I think that Thomas Cook, per se, the travel business and the financial service businesses should do reasonably well over a longer period of time. But the real interest in Thomas Cook is because of its subsidiary Quess Corp. And Quess Corp is India's largest staffing company. It's been a fabulous wealth creator since its listing, and even before that, consistently can grow at 20% plus over the next several years or so. It's a nascent industry per se, staffing solutions. And the way the deal is structured is that before this financial year ends by March 19, for every 100 shares of Thomas Cook, you will get 18.89 shares of Quess Corp. And if you buy Thomas Cook at the present price of around 200 rupees or so, and you compare the price of Quess, which is, you get the net residual value of Thomas Cook is around 71 rupees. And for the last June quarter and September quarter results are expected, its annualized earnings per share is 8 rupees. So it is available at a sub 10 PE multiple for the core travel and financial services business, which can easily grow at 15-20% or so. And then you have Quess Corp, which is a fabulous growth story, a fantastic compounding opportunity over there for investors. So together, if you hold both the shares for a period of 1 to 2 years or so, I think you can easily get 30-40% type of return. There are certain risk factors with Quess Corp because they have a 80 JJA benefit, which the government can tinker with and increase their tax rates. In the case of Thomas Cook, it is subject to various kind of disruptions which take place in the travel industry, including weather or any accidents, terrorist attacks, so on and so forth. So earnings can be lumpy for Thomas Cook, but secular for Quess Corp, but on the whole, positive on both the businesses together.
Okay, all right. Well, we are here discussing 9 stock ideas with our Marketwallah'S. We have done 3, 6 more to go. So let's straight away get to the next round. Mr. Tulsin, you've gone with an interesting stock, L&T Finance, and this is the most controversial part, or has been the most controversial part of the market of late. I think 30-35% off the peak. What makes you confident on this one now?
See, Surabhi, first I thought that you must have some financials also on the Diwali as a Diwali pick, because Diwali being a Lakshmi, this one, and you if don't have any financials, then that's not justice with the Diwali recommendation. Coming on the NBFC saga, I think that sanity is seen to be returning back. In fact, we have seen the bottoming out or happening of all the NBFCs and HFCs both. because the liquidity scenario, which was seen to be as precarious as it was perceived to be about a couple of weeks back, is not seen. The picture is different. The October data have all come in where the companies have been able to raise the money if they have a good pedigree. Now, L&T Finance is a 64% subsidiary of L&T. In fact, the company seem to be doing extremely well, and if you see their revenue breakup, they are into rural finance with a book of about 21,500 crore, housing 21,500 crore, housing finance or maybe the wholesale finance is about 47,000 crore. Total AUM is at 91,000 crore, and the company can smartly raise the money. Just to give an example, the present net worth is about 12,500 crore, which was at around maybe sub 7,000 crore as on last year, about a year back. How that has got increased? Because of the raising capital at 185 rupees by infusion of money by L&T. So they have a good line of credit available, good financial support available, and even in this liquidity crisis, which is in fact plaguing all the NBFCs, they have 6,500 crore as cash and liquid investments. They have 4,100 crore as a bank credit lineup and about 2,000 crore from L&T. That means they can always fall back on this credit line of about 12,000 crore available. And if you see the liquidity situation on 6 to 12 months ALM, asset liability matching, they have a surplus or a positive of about 19,000 crore. Come quickly on the financials, excellent numbers they have posted. GN gross NPS has been at about 7%, net NPA is sub 3%. And if you take a financials also, the net profit is closer to about 1,100 crore for 6 months. They have already declared their the H1 numbers for FY19 with EPS of closer to about 5 rupees. Now the share is ruling at a price to book of closer to 2, because if you take the book value, it is at about 64 rupees at present, and the share is ruling at 128. So taking all this into consideration, I think that if the economy is doing well, which we have been seeing the engineering stocks doing well, automobiles numbers, cement dispatches, steel consumption, the financial lenders will always do well, and we are seeing extremely positive for those NBFCs where you have a strong pedigree and all sort of things. So I think that you have the margin of safety. The stock is seen having bottomed out, though it has seen a low of about 112, 115 in this recent carnage, but now seen becoming, returning back to normalcy with an accumulation seen on every day. So share now ruling at 128 can move to a level of about 160 in next 12 months, yielding an annual gain of about 25%.
Okay, so that is the first NBFC finance stock that we've discussed so far. Now we come on to another interesting sector, and we're talking about TeamLease, Prakash, which is your second pick.
Yeah, so quite similar to the thesis that Deepan mentioned from Quest. Of course, I find both these businesses look very similar and are promising, but TeamLease is a pure play general flexi staffing business that you have, and the opportunity is so huge that. When this company was launched, people actually couldn't fathom the fact that this could, scale up so rapidly in terms of revenue and profitability both. And even now, if you see, the penetration in India is just under 1% on using flexi staffing services. Globally, it's closer to 2, and being such a populous, high demographic profile that we have, we should be looking at seriously bigger numbers. And what has happened to TeamLease is that they started with general staffing, which is still the lion's share of their contribution, which is close to about 96%. 95-96% comes from there. Then they have specialized IT staffing also, and then a little bit of the HR specialized services that they offer, which is about 1% plus. What's changing for them is the e-commerce rapid fire growth that you see, and that primarily depends on temporary staffing. It's a given fact, and we are seeing unprecedented kind of growth rates there. We are seeing a lot of new initiatives by the company that are in the making, of course, right now. Apart from the fact that e-commerce, GST, unorganized to organized, all of that's helping them. They've launched something, an experiment, launching a product instead of a service, which is a SAS-based platform, product. Now, as and when that happens, that's an optionality. It's a huge trigger. It can kind of change margin, because it's otherwise not a very great margin business. But headroom for growth, clear runway, superior leadership. I think all of that kind of, and of course the income tax benefit on the Section 80 JJA, right? That's the this thing, and that is something which is kind of making sure that they have a moat of sorts, which is going to continue. So I think it's a great stock, could have a very decent 20% kind of a growth from here if everything goes off well and the government doesn't tinker around with especially the tax benefits.
Okay, well, that's a call on team leads. Deepan, let's come to your stock, and you are going with Capital First. So, looking at the future and the merger with IDFC Bank?
Absolutely, and maybe Capital First was prescient in that manner when they announced the merger with IDFC Bank, giving them the banking platform to raise resources. And it's a great fit because IDFC Bank is predominantly an infrastructure lender, corporate lender, and Capital First is focused on SME lending, retail, consumer finance, and so on and so forth. And IDFC Bank has made its pledge that they want to increase the consumer finance space in their entire book. So it's a great fit, and the valuation, the way it was done, I think shareholders of Capital First were given a substantial premium, I would say, to the then listed price. Now, my sense is that we get a very aggressive management in IDFC Bank because Mr. Vaidyanathan, who has rebuilt the company almost from scratch, will be at the helm of IDFC Bank. At the same time, IDFC Bank within itself has taken many steps to make the integration process simpler and faster. And whether it's the CRR ratios or whether it is SLR ratios or priority sector lending, they have been able to maintain all those particular ratios and regulatory requirements. At the same time, they have largely cleaned up the balance sheet, and this quarter, for the September quarter, IDFC Bank booked 500 crores worth of provisioning, and after that provisioning, their NPA ratio has come down to just 0.59%. And at the con call, the top management at IDFC Bank were very clear that come January, when the actual formal integration and merger takes place, they will be able to ramp up the operations and scale up the operations extremely fast, considering that a lot of integration issues have been already completed. Past experiences of mergers of bank with NBFC have been positive for the industry, and I think that IDFC Bank eventually will follow the footsteps of other legendary value creators like an HDFC Bank or Kotak or IndusInd Bank or RBL, and will be a full-service retail-focused bank and can provide and be a great wealth creator going forward, and very attractive valuations, or considering the kind of correction which we have seen in private sector banks and NBFCs, easily available at less than 1.5 times its current year book.
All right, so that is Capital First. So 6 done, 3 more to go. We're putting out 9 stock ideas that you can work with, you can look at for the next 1 year. Our Marketwallah'S are here. We are putting out stocks that you can buy and hold to create some wealth over the next year. Mr. S.P. Tulsian, Prakash Diwan, Deepan Mehta are with us, and we've been running through stock. 6 done, 3 more to go. Well, Mr. Tulsian, let's begin with you again. You have your eyes on Schaeffler India.
That's right. In fact, you know, the engineering stocks are seen to be doing quite well, and this is a very interesting play. This is a German promoters, that is Schaeffler. They are holding at present 51%. What they have done, an interesting move, their 2 closely held companies of the German parents got merged with this company, by which the equity got increased from 17 crore to about 31 crore. But interesting part is that the promoter shareholding, promoter stake also in the company got raised from 51% to 74%. So an MNC with almost 75% stake. Now the George Schaeffler, in fact, was here in India, who visited exactly after 6 years to inaugurate one of the plants, because they are very bullish. And in fact, it reminds me of the Bata, CEO, who gave the guidance that they wish to capture the potential in India is seen to have. Similar statement is given by George Schaeffler that they intend to invest about 1,000 crore in next couple of years, or maybe next 2 to 3 years, and are eyeing for a turnover or top line of closure to about 1 billion euros. That's about 8,400 crore in next 4-5 years. If you take the financial performance of the company for first 9 months, this merger process of 2 companies, which I've said, INA and Luke India, that's already completed, and the results which the company has posted for 9 months of CY18 is only before us, where the turnover has been at 3,500 crore. I'm referring for 9 months, with PBT of about 520 crores and PAT of about 310 crore. Now, of this PAT, about 45 crore is the merger expenses which they have debited in 1 quarter. And in spite of that, they have posted an EPS of 100 rupees for 9 months of the calendar year 18. If you add these exceptional expenses also, then the EPS would have been 110. That means they are in a position to post an EPS of closer to about 150 for the next calendar year 19. And if I take the projections to be achieved, where doubling of the top line will happen, you can comfortably expect 300 or maybe 350 as an EPS, for the company in 3 years down the line. Now, if you really see the ball bearing, roller bearing, needle bearing, clutch auto transmissions and all that, all these companies are seen to be doing quite well, SKF and other auto ancillaries. And that has a strong potential because of the BS6, BS6 and because of the safety norms being introduced. So company is in a position, very strong pedigree, debt-free company. So maybe share now ruling at 5,030 can move to a level of about 6,300 in next 12 months or so. Or this can be kept as a portfolio stocks for long term as well.
Okay, so that is Schaeffler India, of course, stock that's very widely held by a lot of the domestic mutual fund houses as well. Let's move to the next one. Prakash, you are going with Welspun Industries.
That's right.
So this is the textile company of the
Welspun group. Yeah. So this is a company that has had a setback in the past, which all of us know about, but now it's making a comeback. And where is the comeback coming from? Because thanks to the pickup in US retail sales, for especially home furnishing and home textile, we've seen that happen. And if you see recently numbers of even a company like GHCL, which is into chlor-alkali, they also had, actually they got saved because of the textile division, which is also into a similar line. Now, Welspun has been investing a lot of resources and energy into expanding its lines. They are well acclaimed in terms of their brand presence and all that. But I think next year, same time next year, 2019, they would have the flooring business that would start getting into commercial production. They've set up a new unit in Telangana and all. And that is something which people have been waiting for. Once that happens, you'll see a company getting into a very different orbit, diversified product mix, has strong relationships. And that's an area where the margins could also start improving. They've had a little bit of a softness in margins thanks to the higher dollar values and the crude going up and transportation costs going up. But that could probably ease out in the subsequent quarters as well as the contracts get reset. So I think my leap of faith on this company is, though it's in textile, doesn't get great valuations, but you have a company which is roughly about 1x sales on market cap, and it's not very expensive. It's 25% down from its high of 82, 81 or whatever. So you could play it safe. Hopefully next Diwali we'll be talking about it more positively.
Okay, so that is Welspun Industries. By the way, we're covering the whole gamut of sectors here, right? I mean, ball bearings, we got textile, and the next one is financials. We have and the staffing companies.
Staffing companies, yes.
The next one is equally interesting, Delta Corp, Deepak.
Well, it's Diwali, and Diwali is not
why not have some
gambling. So it's most appropriate that we should look at a gambling stock. And Delta Corp is a very interesting story. It's like a nice long-term compounding growth story, and it will have its ups and downs because of regulatory issues. But by and large, Indians are gamblers. We have been right from the days of Mahabharat. Globally also, we are known to be big spenders when it comes to casinos. And here we have a homegrown company which is providing a casino right in Goa over there. So the stock sold off recently because the Goa government increased the license fees many-fold. And the street thought that that would impact the earnings of Delta Corp. But the contrary happened, and a lot of weak players got shuffled out of the Goa market for casinos, and actually Delta Corp got more traffic because of lesser competition, and they were easily able to absorb the increased license fee and yet deliver a spectacular Q2 FY19 number. Now going forward, there are of course the Goa business will consistently do well. It's a nice compounding story, but there are other opportunities. The Sikkim casino has already been launched, and with the recent airport coming up in Sikkim over there, that should increase the traffic. At the same time, they have a facility in Daman, but they're not getting the permission. As soon as that permission comes through, that could be another revenue stream for Delta. And there's also the anticipated change in Goa's gambling policy, whereby they will now facilitate on-site casinos, and Delta is ready with its plans, and its land has already been acquired. So as and when this policy is passed, they'll be a first of the block to launch a very large onshore casino as well. So that's as far as the casino business is concerned. What is even more interesting is its subsidiary, which is engaged in online gaming. And that's been an acquisition which they made recently, which has turned out to be extremely value accretive for Delta Corp. And going forward, we are seeing that whether it is actually gambling at the casinos or online gambling, these are businesses which have a great future. I mean, of course, it's a sin kind of a business, and we do not really encourage people to gamble, but nonetheless, there's a business opportunity over there, and Delta Corp is right in the middle of it. And although slightly expensive on a trading 12-month basis, but it's if you consider the prospects 2-3 years down the line, and you hold it for a slightly longer period of time, and assuming that there are no accidents as far as the regulatory aspects are concerned, this could turn out to be a great multi-bagger.
Okay, well, there you have it. You have the entire plethora of options to choose from. Thank you very much, all three of you gentlemen, for joining us and taking us through all the 9 picks for Diwali. Hope it's a prosperous one for you and for our viewers as well, of course.
Absolutely. From all of us here at CNBC TV 18, wishing you a very prosperous and happy Diwali. Thanks very much for staying with us.